Alright guys, we got today a short lecture to finish the money markets, right? Then we take a break before we continue with the bond markets. Now, last time you said we did commercial paper, right? So, unsecured, it depends on the credit ratings, okay? Now, commercial paper, we still got some more about commercial paper. Sometimes shortened as CP. Commercial paper is considered to be unsecured. That's from last time. But commercial paper can be possibly backed. It is can be backed by line of credit. Line of credit is a promise by a bank, by a commercial bank, to make a loan in case you need it. In other words, it is a commitment by a commercial bank to make a particular loan to a particular borrower. Usually, the bank gets, for this line of credit, a fee. They do it for a fee. So, the issuer of the commercial paper will pay a fee to the bank, and the bank will guarantee that in case you get in trouble, we'll give you credit, and you can use the credit to pay back the commercial paper. This line of credit backing is lowering the risk of default. Lowers the risk of default. Now, this line of credit is considered, and another nice financial phrase for it is called loan commitment. The loan commitment, again, is made by the bank to the issuer of the commercial paper in case the issuer gets in trouble to pay all back. Maybe what will happen is the issuer has accumulated some amount of money, and maybe he borrowed 10 million, maybe he has 8 million, and he's short of 2 million. So he will use the 8 million cash, and he will draw a credit of 2 million to cover the difference. And then he'll have to worry later to pay back the bank. Loan commitment. Okay. Commercial paper, the whole idea, or one of the many ideas of commercial paper, is to sell direct. To sell direct simply means that you do not use investment bank. You don't use an investment bank. You do not use a financial intermediary to sell as an issuer to the investor. You sell to the investor directly. Now, the investor will not be you and me. The investor will be a pension fund. The investor will be a mutual fund. The biggest investor will be money market mutual funds. Investor could be potentially a bank or any other financial institution with surplus funds. So the idea is to sell direct, and if you sell direct, you save on what we call underwriting costs. You save underwriting costs. To underwrite means to assume the risk of something, to assume the risk of issuance. And underwriting is the process of selling securities through a financial intermediary. The financial intermediary is called an investment bank. And when you sell direct, you don't use an underwriter and you don't spend money on an underwriter. Means investment bankers go hungry. You skip them, you don't use them anymore. If you're an investment bank, it's not good news for you. But if you're an issuer, it's good news. It saves money. Okay, that's number 4. Number 5 is negotiable CD. CD stands for a certificate of deposit. Negotiable means that the title can be transferred, and therefore negotiable has the meaning that it can be sold. And if it can be sold, it means that the price can be negotiated between the buyer and the seller. Most of these instruments, I was explaining a little bit last time, are bearer instruments. Bearer. Bearer instrument means that whoever has the physical piece of paper and brings it to the bank, meaning brings it to the issuer, will get the money. There is no name on the person. There's no name of ownership. Or sometimes, if there is a name of ownership on the front, every time the ownership changes, on the back there is endorsement, meaning I'm sending it to you. So now on the back your name is written and you have it. If you sell it to her, you will endorse it to her, you will put her name on it as the owner. But usually it's a bearer instrument. I gave you already the example last time. The most prominent bearer instrument is the money you carry in your pocket. You can use it, and whoever has it in their pocket, it's theirs. They can use it. Okay. Denominations would be B. 100,000 or 1 million or 10 million. The idea here is that it's going to be bought again by a financial institution. They're going to buy maybe 50 million, so all they're going to get is 5 certificates, each worth 10 million, okay? A lot of times when it's issued, they will be calling around different funds and say, hey, we want to issue some CDs, and some fund will say, I want a 1 month, another one will say I want 3 months, and the one will say I want 6 months. And they know that they could later possibly sell it to somebody else in case they need it. As well as here, most of these, and that's very common for all instruments, is that they're all purchased by money market mutual funds. And money market mutual fund, is repeating from one of the early lectures, is a fund that invests in money market instruments. So money market mutual funds, in a sense, will be the most active participants in the money markets, and they'll be usually the most active investors, buyers of the money market. Quite often they'll hold this short-term security till maturity. When it matures, they'll get the money, they'll immediately go and buy some other money market instrument, some other short-term instrument. These will be maturity, will have a maturity of 1 month, 2 months, 3 months, 6 months, 12 months. Let's see if they have anything else. No, these are the ones. Let's see what else. The primary market is very similar to this one here. If a bank wants to issue, for the first time the security, they'll contact a bunch of funds and ask them, hey, we got so many securities, and see who actually wants to purchase them. You just send them a call or send them an email. Hey, we got a whole bunch. Do you want some or any? And sometimes they may say, we'll have a lot of 3 months, and sometimes someone will respond back. They say, well, sure, but we want to buy 6 months, or no, we want to buy only 1 month. And they'll make an adjustment. So the secondary market is very similar to the primary market. You shoot an email to a whole bunch of people and say what you have an offer, what you have for sale, and somebody may say, hey, we're going to buy it. And there's a possibility, there is a screen or there's a website, you can buy these and these with this kind of maturity, with this kind of yield, and you say, okay, I'm going to go and buy these, and you contact possibly an intermediary or a broker. Let's see what else we got here. Well, not much. That's good enough. Well, bankers' acceptances are complicated, and probably we don't need to discuss the very detail. Let's try again the basics only. Bankers' acceptance. Banker's acceptance, first of all, is issued by a business, issued by a corporation, is issued by, we say, non-financial institution. So, issued by corporations. Usually, the most common cause or reason will be used in international trade. A banker's acceptance, again, if it's issued by a corporation, is a promise to pay by a corporation. Is a promise to pay by a corporation. And now the second part. to accept, a bank to accept means to, again, assume responsibility in case of default. So, the acceptance part means that the banker's acceptance actually is issued by the corporation first time, so the corporation promises to pay, and the bank guarantees. So, to accept in this particular case has the meaning of a guarantee. The guarantee is made by the bank that the bank will pay if the issuer does not pay or if the issuer defaults. So the banker's acceptance actually is a very low risk. It's a very low risk instrument because now you got two people promising to pay. You got the corporation promises to pay and you got the bank promising to pay. The corporation promises to pay first, and in case they can't or will not pay, then the bank will pay. So it is basically as good as the corporation, but more often it is as good as the bank. It effectively becomes a bank's promise. Okay? So that's the okay, so now we need a few more things. The next trickier one is a time draft. Time draft is very tricky. Okay, so a time draft is an order to the bank to pay somebody an amount of money, to pay, we say, the bearer a specific amount of money on a specific date. On a specific date. Meaning you will write a time draft, let's say 60 days from today on, let's say, May 1 or June 1, the bank to pay the bearer, let's say, $1 million. That's a time draft, okay? And again, the time draft is issued by the corporation. So, technically, the banker's acceptance becomes a time draft accepted by a bank. Accepted by a bank. Accepted means guaranteed by a bank.
So, if this is the case, then wouldn't we create a problem? Like, so the company knows that even if they don't pay, the bank will pay. Wouldn't that be a tendency for them not to pay the problem?
Oh no. Okay, so the question is, well, if the corporation doesn't want to pay, if the corporation knows the bank will pay, then the corporation doesn't want to pay. The answer is no, because the bank will not guarantee for nothing. Bankers aren't that stupid. That's what we're trying to train you here. As a banker, you never make a promise without a guarantee from the customer. So the first thing is the bank will make the guarantee to the corporation only if the corporation is a regular customer of the bank. So the bank already knows this customer for 1, for 2, for 5, or for 25 years. It's possible, if the corporation is old, that the bank may have had this customer for 100 years. If you're a major corporation, and you have a relationship with this bank, and this bank has done you a good service, okay, for 50 years, you're not gonna screw the bank, meaning the relationship that you've built over 50 years, you're not gonna screw it over one-time draft of, let's say, $500,000 or $50,000. So, one of the guarantees here, one of the guarantees is simply reputation. The second one, of course, is ruining the reputation. You got only 30 banks in this country. As soon as one company does it to a bank, we call this thing blacklisting. To blacklist blacklisting means this company, this corporation will enter the list of all banks, and now no bank will ever serve them again. And of course, it's rarely that the bank gets in trouble for this. It's the corporation which needs next time the money, it won't get it from the bank. Okay? So, next time the corporation is in trouble, the bank will be happy to let it go bankrupt for doing it to them. Okay? So, these bad things don't get unpunished. But there is another little guarantee. The customer, whoever is the corporation issuing the time draft, will be, again, a customer of the bank. They will have some cash at the bank, they will have a savings account at the bank, they will have their pension funds. In other words, they will be a regular customer of the bank, and they'll be holding some money at the bank. So, as soon as they don't pay, the bank will take all of their deposits, all of their pension funds, all of their whatever money they got in the bank will take it. You can't just walk to a bank and say, hey, I need a guarantee for $1 million. Most banks will not do that. But your regular bank will do that for you. So you don't want to ruin your relationship with your bank. So relationship is also your reputation. Because as soon as you do that, you will ruin your reputation. Next time you need it, you can't do it. Okay? So that's a relatively simple explanation. Let's see what else I have, and then let's see what questions you may have. The secondary market is not very active. They don't trade actively for a number of reasons. There are a whole bunch of different corporations who issue them. Some could be small companies, middle-sized companies, some could be large-sized companies. And on top of that, it could be accepted by a whole bunch of different banks, from small-sized banks. So you got like tens of thousands of possibilities or combinations of different types of acceptances. And each time draft is usually associated with a particular trade. And that particular trade may be 20 days, maybe 37 days, maybe 47 days. So the main problem is that these are not standard. They're not standard. So what we will be discovering over time is that an instrument is a good secondary market if the instrument is fairly standard, if it's all the same. But these are not the same. The dates vary, the maturities vary, the issuers vary a lot, usually not well known. The bankers could also vary. So this is so non-standard, in other words, it's so customized and individualized that it's very difficult to make an active market. So one of the ideas, as we'll see in the next chapter, in the next hour, is that when you have bonds or T-bills or anything else, you want to keep them as standard as possible so that you can have millions of those, and these could be traded probably millions of times each day. Let's see what else I got here. So the acceptance, we got it. There is still yet another protection. Usually is associated with an international trade. And the international trade is associated with export-import activity. So you export or import goods. Maybe you're importing, let's say, 20,000 iPhones or 50,000 shirts, okay? So the goods themselves will also serve as a security. So you have goods, one company is buying the goods, the other company is selling the goods, the seller will be shipping, and now the buyer is, has to pay the money. Well, the buyer will be issuing the acceptance agreed by the bank. Well, the bank will hold ownership of the goods until the buyer makes the payments. So they say, well, what if the company don't want to pay? If the company doesn't want to make the payment, the company won't be able to get the goods. So now the bank will have the goods, maybe 20,000 iPhones. They'll try to sell them somewhere else, somehow else, okay? Or maybe return them for a small loss. But the bank will also use the goods as an extra security. We called that security last time collateral. So the goods will collateralize the banker's acceptance. They're going to act as an extra guarantee to the bank on top of all the other guarantees. Okay, let's see what else. So, going back to repeat, I already began the chapter with it. The money market characteristics are: number one, large denominations. Number two, low risk. And number three, short maturity. Okay, and let's see what else we have here. Oh, we got another little section before we finish. I've already covered some of it, and we'll do some of it again. Before completing the chapter. The section is money market participants. So, participants. Well, the first big participants for all instruments will be money market mutual funds. They are mostly buyers. They usually buy and they usually hold till maturity. Second, for only the treasuries, of course, the treasury, whether it's the US Treasury, the British Treasury, your Treasury, Hungarian Treasury, the Treasury, the government. They'll be active mostly on the issuance side. Money market mutual funds will be active mostly on the investment or buying side. Next, I already discussed many times, commercial banks. And commercial banks will be active on both sides. Sometimes they'll be issuing CDs, sometimes they'll be selling Fed funds, sometimes they'll be buying them. So commercial banks use these markets for two main purposes. One of them is required reserves. The bank is required by law to maintain a minimum amount of reserves. So the bank will use the money market to manage its reserves and to keep or maintain the minimum required reserves. And number two, the bank will use the money market to manage its liquidity. Again, exactly the same as reserves. If they have too much liquidity, they'll invest it to earn income. If they don't have enough liquidity, they'll use the money market to raise liquidity. So banks will consider to have a certain optimal amount of liquidity. I'm just making a number, that's not exactly true. The bank wants to have 5% liquidity. So if it has 2 or 3, it will want to raise liquidity up to 5%. Or if it's got 7 or 8% liquidity, it will want to lower it down to its target liquidity. So they'll use to manage reserves and they'll use to manage liquidity. Of course, you got all sorts of brokers. Brokers could be for money markets. Brokers could be for stocks, could be brokers for bonds. So you may have a bond broker, and that bond broker may have some excess reserves or is liquidity, okay? And they want to invest it for 1 week, okay? So brokers will be doing that. Another one will be investment banks. Again, investment banks need to maintain their own liquidity. So they might be investing in some. But the main function of investment bank is as underwriters, where they will become the financial intermediary that helps somebody to issue a major amount of, let's say, $1 billion. Somebody, corporation or some other bank or financial institution needs to raise $1 billion. You will need an investment bank to do it for you, whether it's short-term or mid-term or long-term or stocks. So investment banks. Okay. Well, here, going back, there are specialized brokers, we call these, or they're called these money brokers. Money broker. Money broker is a broker specializing in money market instruments. Of course, you have corporations. Sometimes they use the money markets to raise funds, short-term funds. They use it for salaries to buy whatever they need to buy. And sometimes corporations may have extra money. They sell a lot of iPhones. One of the bigger investors in the world today will be Apple. They're making a lot of profits from your iPhones, those the ones that you buy. You buy an iPhone for $700. It costs maybe $250 to manufacture. Apple will make $400 profits. They'll get salaries, they'll get bonuses, they'll get everything else. But Apple will still have a few $billion of excess reserves, meaning that they just have cash in the bank. Well, they're not going to keep it as cash in the bank. Maybe, well, most certainly, they will be investing that cash in some money market instruments to earn some interest on it. So corporations could be acting on both ends. And finally, you will have a lot of insurance companies. Now, insurance companies usually invest. They usually have excess. They usually have more. Well, insurance companies, as we'll get in the next lecture, will be investing in bonds, which are long-term instruments, but they would also occasionally invest in money market instruments. Again, the same old story. To manage their liquidity, insurance companies need to pay salaries, so they can invest in an instrument that matures at the end of the month. They'll get the cash and they'll use it to pay the salary, okay? Or the insurance company may have specific payments to pay, okay? So they know we got a payment coming on that particular date. They'll invest in some money market instruments that the money will come back right before the payment or on the day of payment. So as soon as the money comes, they'll use it to make the payment. So insurance companies, pension funds, and so forth. And the last section is very simple, very easy. Just one summary is that the money market has become increasingly internationalized. The internationalization of, or sometimes they like to call it globalization of the international markets. So American corporations can borrow or lend in the UK, in London, in Tokyo. Now bigger centers will be also Hong Kong and Singapore, or the opposite. Hong Kong banks will be raising liquidity in London. In other words, now the money markets are becoming globally integrated. Okay, and there is plenty of more, and I think that's good enough for today, for this particular lecture.